Hello, everyone, and welcome to our Prime Capital Financial Making Sense of the Market. It's March 5th, 2026. For those of you that I have not had the pleasure of meeting yet, I'm Scott Duba, President of Prime Capital Financial. I'm joined by three members of our investment team. We periodically, when markets get choppy, or at least there's things of potential concern to our clients, we like to have these calls just to make sure we're staying in touch with our clients, whether they be our wealth management households, our plan sponsors, or our plan participants. So today is an example of that. I'm joined first and foremost by our Chief Investment Officer, Will McGuff. Will's been with the firm for a number of years. His career spans over 2 decades across the asset and wealth management space, including cap markets, retirement, and technology ventures. Will's been with us for a number of years. He has oversight over $40 billion of assets, including both our wealth management and retirement practice. So we're happy to welcome Will to the call. In addition to Will, I've got 2 other members of the investment team. Clayton Allison is our Director of Investment Strategy and Portfolio Manager. In particular, Clayton spends a lot of time on our domestic and international stock portfolios, does a lot of individual company research, and spends a lot of time really understanding which sectors, which businesses are best set up to succeed in any macro environment. And lastly, we have Brett Newell, who's our portfolio manager of private investments. Brett oversees all things alternative investments for the firm, whereas Clayton spends a lot of his time on the public markets. We've got a large and very growing and sophisticated franchise in alternative investments, of which Brett has oversight of, including private equity, private debt, and any other non-daily liquid type of investment. So Will, Clayton, and Brett, welcome to Making Sense of the Markets.
Thank you for having us.
Look forward to it.
Okay. So let me run through our agenda. We've got, we think, 3 real interesting themes going on right now that are worth discussing for you, our clients. Number 1 is geopolitics. Number 2 is AI and software. And number 3 is private markets. With respect to geopolitics, obviously there's a lot of different flashpoints across the globe. We'll spend time talking about Iran and what implications that might have on the markets. With respect to AI and software, unless you're living under a rock, you're well aware of kind of what's been happening with innovations in artificial intelligence and how use cases and deployments of those technologies are impacting legacy businesses, including many large publicly traded businesses. And then on private markets, this might be of less note to some people, but there's a connection between the AI and software industry tremors, as well as the private markets, especially private debt. The last thing we'll end with is kind of an overall market outlook, where Will Clayton will kind of recap everything for us. So let's dive in first on geopolitics. We'll start with Iran and oil markets. Will, maybe we'll start with you. Why is this conflict with Iran maybe a little bit different? What's it mean, and how should we be thinking about it?
Yeah, thanks, Scott, and thanks everybody for joining. In my opinion, 2026, which we're only a little over 2 months in, is shaping up to be the year of geopolitical volatility. We had Venezuela, Greenland, and now we're talking about Iran. So very, very interesting year as far as things happening abroad. And so for those that are looking for a recap, we launched Operation Epic Fury last weekend. And so we're only a few days in, and the market really seems to be all over the place with how it is reacting and how severe the consequences of this invasion are going to be as it relates to the markets. And the first thing I would lead off with is Iran's a huge country. It takes up the size like half the United States. But what you can see here is it sits in a very oil-rich part of the world. And a lot of that oil, which we'll talk about here in a second, goes through the Strait of Hormuz. And so over the weekend, US and Israel joined together to launch strikes on Iran. And you can see on the right side here all of the locations that we hit. And in retaliation, the Iranians launched missile attacks at US bases across the Mideast. And so the extent of this conflict and how long it lasts is ultimately going to have a direct play on the oil markets. But we won't get too much into politics here. On the next slide, just a little bit of the rationale that the US military has said for a reason here is that after the bombs we dropped last year with Operation Midnight Hammer, the Iranians have been quickly stockpiling or building towards a future stockpile of missiles that could eventually hit the United States, which is the rationale for which they're saying that we needed to initiate this conflict now. And so with that conflict already been initiated, the main focus, in our opinion, is going to be on the oil markets. On the next slide, you'll see in context of just where oil from around the world comes from. And this has changed dramatically over the last couple of decades. The United States is actually the largest producer of oil in the world. And so this conflict is much less about, our needs to consume oil, but more, I think, a proxy of others that are consuming Middle East oil, namely China. And so what you'll see here is that Iran is actually not a huge producer of oil, but what happens is they control the Strait of Hormuz. And when market participants are fearing a restricted supply of oil across the world, guess what happens? Oil prices go up. And so our next slide shows exactly the extent of Brent crude oil. And you can see it was low 60s just earlier in February, and now it's over $80 a barrel. And so that has huge ramifications across the markets. We've been in an inflationary environment that's been kind of stubborn. CPI, PCE, whatever your favorite measure of inflation, has typically been in like the high twos. For those that need to recall, it was 7, 8, 9% a couple of years ago. So in the United States, interest rate policy is controlled by the Federal Reserve with the dual mandate of employment and inflation. And energy has not been a very big contributor to recent readings of inflation, and that could potentially change. So with oil prices going higher, we have to watch how that's going to ultimately play on the rest of the economy with regards to interest rate policy.
Okay. So, Clayton, maybe you can dive in here. Obviously Iran's a big country. They produce a fair amount of oil. 10% move is a lot. Maybe talk a little bit more about the Strait of Hormuz and why that's strategically of such importance.
Yeah, I think it's a great question. Thanks everybody for having me. Now, it kind of goes back to what Will mentioned. He showed a really good graph and a map out there earlier. The Strait of Hormuz is only around 20 or so miles across. So by Iran controlling the northern shore of that, they can effectively shut down the entire strait through threats of, essentially blowing up tankers. Now, they are not the only country that has access to the strait or borders it. As you could see from that map earlier, these are a lot of OPEC member countries that border the strait themselves, which, as we saw, the U.S. may be the largest producer of oil in the world right now and is a net exporter, which has been quite the dynamic shift. But the group of OPEC is still the dominant oil producing, conglomerate on the planet. So when you essentially restrict the flows coming from those countries, of which the only way that they can export those out is via the strait, and we're talking millions of barrels of oil a day. And as you can see here, we went from them using super tankers, upwards of 50 tankers a day, traversing the strait up until the first U.S. strikes hit, to now we're essentially zero. Like, there's no traffic going through. The Iranian government has threatened to essentially bomb any ship that tries to use the strait in any way, shape, or form. And this does have carry-through effects to what Will was mentioning of the price of oil. As we've got now 150 ships roughly stranded, just sitting in the strait, waiting to traverse to those OPEC countries, that's going to increase freight rates. As you can see, we've seen a 94% increase in freight rates. And these have carry-through effects. It's not just the price of oil. It's these freight rates also impacting energy companies that then have to raise their prices to make sure that they are still making their profits. And that carries down through to the price of gas that you're going to see at the pumps, at which point then carries all the way through to, like what Will mentioned, the price stability that the Fed likes to monitor and inflation. And, we'll go through the next slide really quickly here, but ultimately, like Will mentioned, oil and gas and energy costs have largely been disinflationary or deflationary for quite some time now, with the administration managing to keep oil, lower. But any type of restriction on supply is obviously, it's just, high school economics, supply and demand. We have all this demand, and if you materially restrict the supply, and I just want to, illustrate that over here. we're talking about roughly 20 million barrels per day that traverses through the strait. To contextualize that for everybody, that's about 20 to 25% of the world's oil total going through there just every day. So if you wipe that off the map and essentially restrict any traffic, well, that's materially going to have impacts to the price of a barrel of oil. Now, the fact that the U.S. has become a net exporter thanks to this shale revolution and a lot of our domestic side production here does keep the U.S. relatively insulated to that extent. And as you can see, the main people that are going to be facing headwinds here are a lot of the Asian countries, China, India, Japan, South Korea. 84% of this oil that's going through the strait goes to Asia. So this is actually going to have material impacts to China, at which point, like we mentioned earlier, not trying to get obviously political in any way, shape, or form. We have rising trade tensions with China at the moment, and this is going to be a material headwind for them. They did just kind of come out and announce that their GDP target has been lowered for the first time in quite some years. Traditionally, they aim for a 5% GDP target. They lowered it down to 4%. I think I saw just 2 days ago. And I can only imagine that a restriction of their energy supply is going to be a material cause for that GDP restriction. So while this doesn't have a direct, immediate impact to the U.S., we are seeing it obviously in equity markets with energy companies right now catching a little bit of a boon from the rise of energy costs because especially with those oil majors, Chevron, Exxon, they're globally integrated. They make more when a barrel of oil goes up, but at some point there becomes, quote unquote, demand destruction. And really, there's a couple different scenarios in which this kind of plays out. Obviously, there's a ceasefire that will help alleviate some of the pressure on oil prices, bring Brent crude and WTI back into where that trading range that we were seeing probably closer to the beginning of February. Obviously, there's less geopolitical tensions. That doesn't necessarily mean a regime change, but more return to status quo. Now, if we see a regime change, and the strait reopens, things go back to normalization via global supply chains. Now, it would still probably be an authoritarian government, but not open conflict with the U.S. and Israel and causing disruptions there, probably brings it back down into a similar range as well. Now, the big tensions that come that are going to impact prices and oil is if this becomes a protracted conflict in the Middle East and war is tried to extend it out, not just weeks. We did see the administration come out and say, they're hoping 4 to 6 weeks. But, with these kinds of things, it's very hard to anticipate any, rough time frame because you're not always taking into account rational actors. Right now, we have Iran not just even attacking U.S. military bases or Israel military bases in the Middle East. They're attacking Dubai hotels and apartment structures and things like that, and just kind of spreading wide range chaos to an extent and kind of drawing a little bit of everybody into this. So depending on how long this persists, we could see elevated energy prices for, a protracted period of time, which would then obviously, like we talked about, flow through into inflationary pressures, which is the last thing you want to see when the administration has worked so long over these last couple of years to bring inflation down from 9+% all the way back down to that 2 to 3% range. And we've got a new Fed chair coming in, hoping to start cutting rates again with a relatively stronger economy. But that's kind of where we're sitting right now with the Iran conflict and what we kind of see going on with the strait at the moment, Scott.
Thank you, Clayton. And well, maybe just to ask one question or one other thought on here. I mean, I would assume when you zoom out a little bit, we're talking very short term, what Clayton's alluding to with the short term potential oil price implications. But isn't there also a scenario where longer term this is potentially good for oil prices and lower? I mean, on the one hand, you've got Venezuela, which has got the largest oil reserves on the planet, potentially now in more friendly hands. And you've got Iran, which has been under tremendous economic sanctions. It really has not had a lot of international oil company investment in their infrastructure over the preceding decades. I mean, isn't there also a case where longer term, this short term inflationary pressure could, if pulled out successfully from a government standpoint, end up being a catalyst for lower oil prices if you can unlock these global flows?
Yeah, I would agree with you. It just maybe the $1 million question is how long is long term? It's, getting a more direct presence in Iran with the right types of oil producers to help onboard all that supply, probably going to take a little bit of time after any type of regime change or change at the government in Iran. And as Clayton's chart showed, a lot of that oil is going, I guess, eastward instead of westward, towards China and Russia. So could that be the next proxy issue after that? And is the administration going to want oil going east instead of west, would be the questions I have.
Okay. All right, well, let's turn the page to our second topic of the year, AI and software volatility. Well, maybe we'll stick with you on this one. In addition to your investment management expertise, you've had a lot of experience in the fintech space and used a lot of these tools yourself, Claude, Anthropic, ChatGPT, all the above. What's going on with Anthropic, and why has it been so impactful to where software companies are trading?
Yeah, so I was going to lead this one off as I wish this stuff was around earlier in my career, because a lot of what our guys and girls on the team are doing now with hardly any programming experience is vastly better than what I was doing earlier in my career. So we're seeing it firsthand that AI is making things more efficient with regards to how we can operate our business. Hopefully you guys on the phone are seeing the same basic effect of AI just being an overall productivity and efficiency play. To the extent that it's going to cause problems of other industries and the economy and labor and such is still to be determined, as we're in a couple of early innings, but we're getting a preview of that so far this year. And I would say all the headlines around AI and Anthropic, and then we'll talk about private debt next, I think buried a lot of the militarization towards the Middle East, which was kind of a number 3 topic going back 6 to 8 weeks ago, and now it's kind of flipped there. So anyhow, this is a little bit of what's happened this year. What we're looking at here is a software ETF. In the tech world, there's really 2 things. There's software, which are computer programs, and there's hardware, which you run the software on. So when you hear about AI and hyperscalers and data centers, that's mostly hardware. Software are the companies that then come and use the hardware to run their businesses. Think about Salesforce, Intuit, Adobe. Those are all softwares and became wildly popular after the .com bubble over the last 25 years. So what's happened is specifically Anthropic, which is a private company that has one of the most popular language models called Claude, has over the course of this year released a lot of headlines that they have new capabilities that specifically do what some software company has built their billion-dollar business to do. That has the market freaking out and selling software stocks. And you can see here the price of the software ETFs has gone from 105 to below 80. And we've highlighted a couple of headlines along the way where different Anthropic products have been launched. And so really what we're seeing, in my opinion, is all these growth software companies being re-rated to more core or value companies in real time, because Anthropic and OpenAI and all these other private companies are going to be the new growth companies as soon as they come to the public market. So Anthropic is causing a lot of consternation across the software industry. And so where this goes going forward is, I don't think it's going to make these businesses go to zero. It's just causing the market to rethink what they're really worth. And there's 2 things to value what they're worth. How much are they going to grow earnings? And then how much do you pay for that, the price to earnings multiple? And so their earnings are probably going to tick down a little bit. And what people are willing to pay for it has come down a lot. So that's how you see big moves like this. So it's talked a lot about Anthropic. Let's actually see their success by comparing them to the other popular AI website and language model, which is ChatGPT, which is owned by OpenAI. And so if we go back, this is not much data on this chart here. If you're looking at early 2025, so about a year, you can see a lot of blue on the chart. Those are all ChatGPT uses across businesses. And so you can see the quick ramp up where Anthropic was under 10% or lower early on, and it's now 60% or higher. So it's become increasingly a very popular tool to be used by businesses. And I think it's kind of cool looking at some of the data on the right. This is actually measured from looking at real-time credit card transactions. So that just kind of shows you how quick information is moving these days. On the next chart, we'll visually show you what I spoke about earlier. And so again, there's two things to value an index or a company: or its earnings growth and its price to earnings is what you pay for it. And so if we look here, the S&P trades right now at 21 times. It's a little high relative to historical averages. Consumer staples represents stocks or brands that are used by the consumer. Think Procter and Gamble. Software is now the same PE as consumer staples, which is kind of in line with the S&P 500. Prior to this sell-off, if we go back to peak 2025, it was trading at 35 times. And so software is cheaper now than it was last year, which is a good thing, in my opinion, because you can get a little bit more value out of software if you're bullish on its potential to grow earnings going forward. And so the other major topic that you see here with AI is how is it going to affect employment? Are a lot of blue collar or administrative jobs going to be lost because they're able to be replaced by AI? It's kind of the million-dollar question right now in the markets and economy. I tend to think it would maybe slow future hiring as it increases productivity. You need less people versus some of the layoffs being more specifically driven by AI. But what you specifically see here is an average employment growth by two different categories: those that are involved in technology or AI, and then those that are more office and administrative. And you can kind of see a little bit of the early effects here of 2025 office admin is just not growing at all. It's down a little bit, and it's expected to actually contract some as we get further into this year. Same premise holds true with software, but it's still going to grow at 6%. So AI is a fascinating topic here. Their Anthropic CEO is saying it could replace half of all entry-level white-collar jobs in the next 1 to 5 years. I mean, I'm embarrassed to admit this, Scott. You're a little bit ahead of me on using some of the AI tools like directly on your worktop. Do you feel the same as the Anthropic CEO here?
I do not. I think when you zoom out, artificial intelligence is a tool in the same way that the internet is a tool, computers are a tool, electricity is a tool, railroads were a tool. I think that often when there's a new technology that's exciting, it's very easy to gravitate towards the kind of doomsday, negative, kind of dystopian scenarios. When in reality, what's happened time and time again with any technological innovation going back not just decades, but centuries, it's the firms that adapt and train their people how to use said new technology that do the best. And inevitably, those firms grow faster and they create new jobs for new people. So do I think that there will be efficiency gains in administrative functions? Absolutely. But I think it's just going to create a lot of potential for those people to be redeployed in things that are more impactful. I mean, we see it in our own business. I think, I forget who said this recently, but I think it was the CEO of Microsoft, maybe even one of the execs at Anthropic. But there's a huge gap right now between what artificial intelligence platforms can do and what people are using them to do. To use an analogy, it'd be like if, a couple of years into the internet, you had e-commerce, but you were still just using it to email and you weren't using it for e-commerce at all. Or you had the ability to do cloud computing, but you're still just doing email. I'd say right now, a lot of the use cases are still people using chat functions for research, effectively like a souped up or amped up or more intelligent Google search, whereas the capabilities to actually make productive output and really kind of do more of an editing or copywriting function as well as actually produce content is there. So I think it's really going to depend on kind of how well firms train their people to incorporate these tools into their day-to-day work. And I think long-term, it's going to be a big positive to productivity in U.S. growth. But with anything, there's always a little bit of a bumpiness and dislocation over the interim. Okay, so let's jump to private markets. Brett Newell's been saving his voice for about a half hour. Brett, private markets, private investments, we spend a lot of time on it. It's probably one of the most topical conversations we have with our investors, especially our sophisticated investors that are looking to really maximize their portfolio allocation. Can you just talk a little bit about private credit? What is it compared a little bit to public credit, public bonds, and maybe just set down some of the terminology that people might be seeing when they're reading about what's going on in the private credit markets?
Yeah, absolutely. Thanks, Scott. So starting at the highest level, private credit, typically classified as direct lending. That makes up somewhere between 50 and 75% of the $3 trillion private credit market. That typically happens when you see a company borrow directly from a non-bank. Now, these pools of capital are typically held in some sort of vehicle structure. We've really seen a rise within the past 5 or 10 years or so of the business development company structure. These can be publicly traded, but more recently we've seen a rise in the non-traded or the semi-liquid vehicles. So these vehicles will offer typically monthly purchases. You can usually get out of them on a quarterly basis. However, there are some guidelines that these BDCs must follow, where they usually offer 5% liquidity per quarter. And so recently, as you and Will highlighted within the software universe, which has been a very popular industry for both private equity as well as private debt, there's been a re-racking in expectations among some of these loans that have been made via these business development companies. All that to be said, I think what we're really seeing the core risk around private credit in particular right now are headlines such as what we are seeing down here in the bottom right-hand corner, where when I'm looking underneath the hood of these portfolios, fundamentals still look pretty good. There are absolutely some laggers within some of these portfolios, but by and large, the fundamentals look very good. So I think what we're seeing now is more so an example of investor behavior where there's a mismatch between the portfolios, those short-term redemption windows that they're offering, whereas the underlying portfolio typically has a maturity in the 3, 5, occasionally the 7-year range. And so moving forward, I think we've got a couple of really good examples here where there was certainly some noise going into the end of last year, but really came to head when Blue Owl announced recently that they were going to sell a relatively small portion of their overall private credit portfolio, but a meaningful portion of their OBDC2, which was largely aimed at individual investors rather than institutions. I do think that it's important to note that this particular OBDC2 vehicle was always meant to be a finite life vehicle. It was not meant to be perpetual. Blue Owl was always intending to return capital back to investors. It seems like the market took it as a reaction that they were going to be withholding liquidity in perpetuity from investors. And we think that that was maybe a little bit more miscommunicated. As such, we've seen a large uptick in redemption requests, not only within the other Blue Owl vehicles, but also within the largest BDC, Blackstone's BCRED. This is a vehicle that we have used. We've had a great experience with them, have a lot of confidence in the team's ability to build out that portfolio, their underwriting, their maintenance, and monitoring. Needless to say, they did receive requests for liquidity above their 5% gate, nearly 8%. They were able to give 100% liquidity, and they did that via some cash infusion from the firm itself, as well as some employees. All total employees added 150 million. I believe Blackstone, the firm, added around 250 million to try to stem the tide here and make sure that it didn't force them into a sale of some assets that they still have some good conviction in. And so they were able to go ahead and redeem 100%. all that to be said, I do think that we're probably going to continue to see some headlines surrounding this, probably going to see some upsized redemption requests, here over the next several months. And I think we can really look back to 2022 when another Blackstone vehicle ran through a very similar scenario, the Real Estate Investment Trust, more commonly known as BREIT. And using that as a case study, it took about 2 years for Blackstone to really work through those heightened redemption requests. That being said, though, they were able to weather the storm very well, I would say. And overall, that product has continued to perform what we would consider very well relative to a lot of its other peers. So on the next slide, sorry, Scott.
Maybe just to back up a little bit, that's a great sort of walkthrough on Blue Owl and BCRED, but is it fair to kind of connect these dots between AI technology, jitters, technology companies typically being about a fifth to a quarter of the assets in these portfolios, and owners of those debt portfolios maybe not necessarily seeing defaults yet, but just being a little bit antsy and nervous? Is this kind of the linkages that's causing the demands for redemptions?
Yeah, I think so. Where just the speculation that these private companies are going to be struggling as AI takes over larger portions of their addressable market. That being said, to your point, we haven't really seen that come through in the information that we've gone through, where, again, there are certainly some laggers within every portfolios, but then we're also seeing some winners and some portfolio companies within these that are actually being benefactors of this AI movement. And, I think on a previous slide, we were calling it the K-shaped economy. But if I can extrapolate this out, I think that's something that we'll likely see within the private credit space, where these high quality managers that have a 20-year track record of managing investments through market cycles, they have really strong underwriting processes. Those are going to be the ones that I think identify the benefactors and winners of AI. Whereas on the flip side, we've also seen a lot of new entrants into the private credit space and private capital as a whole. I think those that maybe don't have as strong of processes and that were fighting for competition for deals to be done, those are the managers and the funds that I would be a little bit more concerned about.
Okay, got it. Your last slide here has some good stats on here. Before you get into that, maybe just to be clear, tell me if I'm incorrect. Typically, the amount of debt on these individual portfolio companies is a quarter to less than half the enterprise value. So there's still a lot of equity cushion. Recovery, when there ever is a default, is usually pretty high because it's good collateral relative to the loans. We're getting paid a lot, right? Investors in private credit are making a big excess spread because they're taking a liquidity risk. And thus far, we really haven't seen a lot of real actual impacts on either defaults or recoveries. Is that fair? And maybe then walk us through some of your other talking points here.
Yeah. I think those are all fair points to say. Again, as we're kind of looking underneath the hood of these portfolio companies, while they are leveraged, the leverage usage has been very prudent, I would say, over the past couple of years or so. And then again, to your point, there's a lot of capacity that we could still potentially see, even in the event of a downturn. If we're using public markets as an example, software down approximately 25% year to date. Most of those portfolio companies are still going to be in pretty healthy positions. And then to your point on the recovery rates, a good portion of the direct lending market is senior secured first lien. So in the event that a default does happen, these portfolios are typically the first ones to get paid and will get the most recovery out of anybody within the capital structure. All that to be said, though, we do think that it's important for diversification purposes. We on our platform have specifically selected managers that are large scaled platforms and can offer a lot of diversification in the number and the types of credits that are within those portfolios. And to your point too, we've still been collecting a pretty good yield premium over the public markets. It's been ranging somewhere to the tune of 200 to 500 basis points over the past couple of years. We generally think that should continue. On top of that, because these loans are not publicly traded, they also come with an illiquidity premium that can be compounded over time, which we think is a really powerful tool. And then again, just to reiterate here that the liquidity risk is not a reflection of the underlying quality of the underlying portfolios. Again, we really saw this validated with the transaction with Blue Owl. A lot of times when we see somebody being forced into liquidity, they will take a steep discount to what they have at mark, 10, maybe even 20%. That was not the case with Blue Owl. They almost got 100% of their marked value, came through at 99.7 across 130 different loans. They were not selling off the crown jewels of the portfolio either. It was very much so pro rata, broad-based across their portfolio, and they still have exposure to many of these loans. So just want to reiterate that the importance of manager selection, because I do think that this is something that we're going to see play out over the next several months, potentially even years. The high quality managers will be the best performing. Those that are lower quality will likely struggle going through the next several months, and we'll likely see an expansion of manager diversification dispersion, over those coming months. And so again, just want to reiterate that we built our platform around those managers that we feel are very high quality. They've given us good transparency within their portfolios, and then making sure that we line up the appropriate allocations with our client base.
Great. Thank you, Brett. Appreciate that deep dive into private credit. Will and Clayton, I'm going to turn it back to you to recap for us kind of the overall market outlook. Clayton, maybe starting with you, what's the S&P been doing historically year to date? And maybe just frame how we should be thinking about performance in light of these three different kind of topical headwinds.
Yeah, of course. Now, I mean, everybody's seen it. It's headline after headline after headline. Volatility seems to just be outside of the realm of expertise for a lot of people right now. And every time you turn on the news, it's a new thing that's going on that's whipsawing markets. But coincidentally enough, the markets are largely flat year to date, which is very interesting. I mean, after today, they're probably going to be down a little bit. And I'm seeing that the S&P is down about 1% right now. So S&P is finally going to turn negative year to date so far. It took 2 months of enhanced volatility to get there. However, the interesting thing is, like, this to me shows that there's a lot more broadening out of the underlying indices, because before 40% of the index is being powered by Mag 7, the top 10 names. There is a lot of overweight to mega caps that are going on right now, to where if they're not propelling anything, the market's not really moving, but they are kind of dampening a little bit. And we're seeing a lot of other sectors outperforming year to date, like industrials, energy, staples, rotation into value. And once again, the market's being flat year to date is very interesting to me because, and I think we're going to touch on this briefly in another slide, but the average constituent of the S&P 500 year to date so far is moving in absolute terms anywhere from plus or minus 10%. So for the average name to be whipsawing 10+% and the overall index still being relatively flat is pretty crazy, at least in my eyes. It just kind of shows you that there's a lot more going on under the hood for the S&P than just what we're seeing on the top line. Now, wanted to show kind of a breakdown of annual returns. We could have obviously backdated this, for 100 years for everybody to see, but that might have been a little bit too much information to take up the entire screen. But what we want to articulate to you is that volatility is very normal. We do see that, dating all the way back to 1980, the average drawdown of the S&P is 14%. Now, that doesn't mean, the market is down 14% year to date, but from its absolute peak to its lowest level in that interim year period, it can contract as much as 14%. And yet 75% of the time across that time frame, the market ends up positive. Now, we obviously are never going to be sitting here saying we have a crystal ball and we know how the market's going to end the year or anything like that. But it kind of goes to show you that while markets are volatile, you have to have a longer term plan in place and be willing to understand that you're on track for your particular financial plan or your investment objectives. That's why we really, talk to your advisor, make sure that you guys are on the right financial plan to where when you see, headlines that we're kind of in open conflict with Iran or Anthropic is releasing a new AI plugin that can do your dishes at home, that the entire market is not going to just sell off and you're doomed for the next 5 years. Context matters, which is why we're trying to give you all of this information. So a lot of stuff going on under the hood, but markets have relatively been flat so far year to date, which is the impressive thing. But I'm going to kick it back over to Will, who's going to kind of talk about more absolute range volatility that we've seen historically on top of that.
Yeah, I'm just going to echo what you had said, is that a whole bunch of headlines this year and a whole bunch of different topics. And the S&P has not moved. We've been, quote, index levels anywhere from 6,700 to 7,000. And it really hasn't, it's flirted with the 7,000 level going back to last fall. So with the S&P staying in such a tight range, the percentage from the high of the year to the low of the year is 3% for 2026 in January and February. You can see that based upon recent history, we're used for it to be anywhere from 6 to over 12% move or range in January and February. So that probably explains, if with some recency bias, why it may be confusing this year that the S&P is not moving. We've talked about conflicts and volatility drivers, but at the end of the day, S&P 500 earnings are growing 13%. So that means that the value that these companies are creating is going up double digits. What you pay for that value has come down, conversely about 13%, is how the markets are flat this year. And so what I'll be watching is to see which way the market breaks from the range that it's set. And from a technical perspective, it typically has a little bit of momentum. Once you stay in a range for a long period of time, it tends to move. It's kind of like a rubber band that breaks. It's going to move the direction of the break, either up or down. And we're kind of flirting with the lows again right now intraday. But to put in this perspective, some other themes we're seeing in this year is, again, international is extremely attractive. And what we're showing here is a couple of international indices, the UK, Japan, emerging markets in Europe. You're looking at what's called a box whisker chart here. So the top and the bottom of these individual bars are the whiskers, the box is the box. So it shows you the range, the 25th and 75th percentile is the box. And you can just look across this chart and see that the US is higher than all of the others. So the amount that you're paying for the earnings of an average US S&P 500 company is over 20x, where internationally it's in the teens. So there's a little bit of a catch-up trade there where international is undervalued. Earnings growth is starting to come online, earning multiple expansion, the dollar's weak. And so we don't have enough time, unfortunately, to get into a lot of the drivers of that with regards from capital flows and such. And so, again, I think that there's ways. We've focused a lot on the S&P 500, maintaining prudent diversification. We've talked to you, S&P 500, small caps have done well this year, which are smaller stocks in the US. Here's international, bonds are attractive, private investments are attractive, but these are all really conversations that are more geared towards a financial advisor because they would know your individual unique circumstances and risk tolerance and time horizon. And so with that, I'll turn it back over to you, Scott, to wrap it up.
Thanks, Will. And thank you, Clayton and Brett as well. Just hearing Clayton talk about drawdowns in the markets, it just reminds me that the news and headlines are meant to sell advertisements, not to help people make good investment decisions. And I think we see that time and time again. Volatility, it leads to the risk of overreacting, and staying invested, we find, is one of the best possible strategies you can employ. The markets absorb the shocks. The investors that stay invested capture the recovery. The biggest risk isn't necessarily the volatility, it's missing the rebound. If you look back historically, if you miss just the 10 best days in the market over the past 20 years, you'd have only half of the cumulative compounded return. So while it might feel like a safe move when markets get volatile to pull your money out, typically the best days come after the worst days. So we always coach people to stay invested, and if anything, look to take cash on the sidelines you have when markets are down to buy good compounding investments. The other point Clayton made is a good one, is that volatility intra-year is normal. On average, down 14% is that's what it's been for the past 45 years. So thus far this year, it's been pretty muted. And even when things are down, that doesn't necessarily mean it's going to be a bad full year. And lastly, just with respect to geopolitical conflicts, history rhymes, it doesn't repeat. But in most prior conflicts, you'll see an initial drawdown, but things recover within pretty short order, whether it's the Gulf War, the Iraq invasion, when Ukraine was invaded by Russia a few years ago. Oftentimes, markets will bottom pretty quick and come back even more where they were before. In the real big picture, just to note, big conflicts tend to be economically stimulative and inflationary because there's a lot of spending, on defense and those type of expenditures. So, to recap, we always advise people to stay invested. Drawdowns are normal, and with geopolitics, it's a headline that might make you want to do something, but staying invested is usually the best course long term. With any of these topics, by all means, please reach out to your Prime Capital financial advisor. That's what we're here for. Whenever you feel like you need to have some expertise, that's what our people are for. So with that, I will thank everybody for tuning in today. And if you need any help, I'm sure you know how to get a hold of your Prime Capital financial advisor. And if you need one, feel free to reach out. So thank you, Clayton. Thank you, Will. Thank you, Brett. Everybody have a good day.